Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to Money Talk for the final time this week. It's Friday the 9th of August. This is Peter Lewis with today's top business, finance and economic stories from around the Asia Pacific region. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's headlines, the Reserve Bank of India kept its repurchase rate unchanged at 6.5% for the 9th consecutive meeting, as expected yesterday, while it maintained its stance of remaining focused on the withdrawal of accommodation. RBI Governor Das said India's growth remains strong and inflation is broadly on a declining trajectory. Australia's central bank governor said inflation remained too high and that the bank's board was prepared to raise rates once more. Reserve Bank of Australia Governor Michelle Bullock said in a speech, the board remains vigilant with respect to upside risks on inflation and will not hesitate to raise rates. She added the board considered a hike in its meeting last Tuesday, but current rates are still deemed to meet the inflation mandate. New applications for US unemployment aid, which is a proxy for job cuts, fell to their lowest level in a month, easing concerns about a rapid deterioration in the labour market that followed Friday's jobs report. The number of people claiming unemployment benefits in the US fell by 17,000 to 230,000 in the week ending August the 3rd. That was below market expectations of 240,000. Despite the latest decline in jobless claims, the claim count remains significantly above this year's average, as the US labour market has softened since its post-pandemic peak, although it remains historically tight. Equity markets in the Asia-Pacific region stabilised Thursday after a week of volatility. Japan's Nikkei 225 closed 0.7% lower. That follows 4 consecutive days of extreme volatility for Japanese shares. The Nikkei 225 plunged 12.4% on Monday before rebounding 10.2% on Tuesday. Monday saw the biggest points loss in history for the Nikkei 225, while on Tuesday the index recorded its biggest points gain ever. On today's programme are Andrew Sullivan, founder of Asian Market Sense, and Sunil Kashyap, director of Finmet. And in the second part of the show, we're going to have a discussion about climate change policy in Hong Kong with Lawrence Yu, executive director at Civic Exchange. Today's Asian business newsletter is ready. You can find that at peterlewismoneytalk.substack.com. On Wall Street Thursday, the S&P 500 posted its best day since November 2022. Those moves came after US jobless claims came in lower than expected earlier in the day, helping to ease concerns over the US economy, which was sparked by a weaker than forecast non-farm payrolls report last Friday. The S&P 500 advanced 2.3%, closing at 5,319. All 11 S&P sectors rose, led by technology, which jumped 3.3%. The Dow surged 683 points, that's 1.8%, to 39,446. The Nasdaq Composite added 2.9%, ending at 16,660. That's its best day since November 2023, and that was the 8th consecutive 1% plus daily move for the Nasdaq. The major averages are still lower week to date, but have recovered much of their losses from Monday's rout. The S&P 500 is down 0.5% for the week, while the Dow and Nasdaq are lower by around 0.7% each. US Treasury yields hit their highest level in a week as stronger than expected jobless claims figures eased recession fears. The 10-year Treasury yield rose 3 basis points to 4%. The 2-year Treasury yield rose 5 basis points to 4.05%. The yen fell against the dollar on Thursday, helping equities to rebound from the sell-off earlier this week, which was fueled in part by the unwinding of the carry trade using the Japanese currency. The yen was last trading at 147.25 against the dollar. The offshore yuan was unchanged, around 7.18 renminbi per dollar, ahead of today's important inflation data from China. Spot gold settled 1.5% higher at $2,423 an ounce. Oil prices continued their rebound after hitting a 7-month low on Monday. Brent crude oil settled 1.1% higher at $79.16 a barrel. And Bitcoin is 8.5% higher at $59,770. Chinese shares were almost unchanged yesterday on the mainland. The Shanghai Composite was flat at 2,870. Hong Kong's Hang Seng Index rose 14 points, that's under 0.1%, to 16,892, and the tech index fell 0.5%. And futures markets are pointing to gains for Asia's markets at the open this morning. First of all, Hang Seng futures projecting a gain of about 240 points for the Hang Seng at the open, that's around 1.4%. Futures in Singapore are projecting a gain of over 900 points for the Nikkei 225 at the open, that's about 2.7%. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Final day of the week. Let's welcome our panel for this morning. We have with us, first of all, Andrew Sullivan, who is the founder of Asian Market Sense. Morning, Andrew.
Good morning, Peter.
And also with us is Sunil Kashyap, who is director of Finmet. Good morning to you, Sunil.
Good morning, Peter.
Equity markets in the Asia-Pacific region stabilised Thursday after a week of volatility. Japan's Nikkei 225 closed 0.7% lower at 34,831. That follows 4 consecutive days of volatility for Japanese shares. The Nikkei plunged 12.4% on Monday, then rebounded 10.2% on Tuesday. Monday saw the biggest points loss in history for the index, and Tuesday saw the biggest points gain ever for the index. Japanese stocks have witnessed a combined 20% fall over the 3 sessions from last Thursday to Monday this week, which wiped off the equivalent of about $1.1 trillion off the value of one of the world's biggest markets, although a lot of that has since been regained. Andrew, let me ask you, first of all, is this volatility over now?
No, I don't think so. I mean, if you consider that for the last couple of years, volatility has been ridiculously low, I think there's just an indication that, people have been ignoring it largely. I mean, we've seen that in the way they've treated the Magnificent Seven, treating them almost like government securities. And, there has been a call to reality now. And the thing is that, last week we saw the VIX, earlier this week we saw the VIX almost hit 60. That just tells you that there's a huge amount of volatility out there. And that doesn't go away overnight. It'll take some time for that to correct and stabilise.
Sunil, I mean, when you look at some of these moves, how on earth does a developed, mature market like Japan, one of the biggest markets in the world, drop 12% one day and then rally 10% the next day? This surely isn't the way that normal rational markets behave. I know markets often aren't rational, but this seems very extreme, doesn't it?
Yeah, I think what's been happening is that the general sort of sentiment of investors has changed, right? We've seen so many years of basically a one-sided market, the market going up, especially since COVID, since the dip during COVID in March 2020, the markets have been trending up, and we've seen almost a one directional kind of move up. So that's attracted a lot of investors, smaller investors, and they've just been buying, like Andrew said, they've been buying equity, especially the big cap equities and tech equities, thinking it's easy. You just buy, hold, and then sell, and you make a profit. And so the sentiment is that it'll be a one-sided move, and so you'd have to worry. And then when you see a slide, suddenly people panic because they've got no patience. They've just been thinking it's a one-sided bet, and then they bail out, and then you see these huge swings. So that's the problem now, because we've been having this sort of strange market in terms of long-term horizon. The last 4 years have been kind of one-sided, and that creates a situation where if there is a problem, people panic, and you see big volatility. But you also see a situation where people who are out of the market and had cash on the sidelines come in on dips, and that's why the market rebounds so fast again.
And are they still buying the dips and chasing the rallies?
It would seem so, right? You saw Dow have a record day yesterday, and generally you've seen some of the risky assets like Bitcoin, for example, went from 60,000 to 53,000, and it's back to 60,000 within a week. Gold similarly. And so it seems that while some people are bailing out, there are other people on the sidelines waiting for dips to buy.
What has caused this sudden change in sentiment over the past week or so? I suppose, in other words, what is behind this volatility, Andrew? What are the reasons we're suddenly seeing this now?
Well, I think there are a number of things. I mean, one was, we had some slightly disappointing earnings, from those the Magnificent Seven, which made people start to think about how they were going to monetize AI and how much expenditure they were putting into it. And that's very much looking at future earnings, and people started to get concerned. Then we had the surprise from the Bank of Japan that they raised rates again. People were thinking, well, they've changed the policy, but they'll take time to wait and see before raising rates again. And that prompted a lot of people to unwind that carry trade that's been in place for literally the last 25 years. And obviously, the easiest way of unwinding that trade is you've probably taken the yen and put it into something else, but the easiest thing to sell were yen equities. And that prompted the correlation between Asian markets now, Europe and the US, is quite high. So if you see a massive selling in Asia, you're going to have a similar reaction in Europe and the US, and that's exactly what we saw. But the key thing really is, I think as Sunil was just saying, it's sentiment. I mean, people were pricing these markets for perfection. These markets were trading near highs. And the moment that you realize they aren't perfect, then you have to reconsider your whole position. And I think that's what you've seen people do. Unfortunately, the initial reaction is that knee-jerk reaction, I need to get out. And that's what we saw happening first.
Correct. I think, you had, especially over the last 12 months, you had a lot of rational investors who would have taken profit at different levels and maybe did take profit at different levels and then saw the market rise up again. And so you had a lot of people, sensible money, which went into equities, knowing that this seems unrealistic, but the market was moving in one direction. So I think they were all nervous, but yet they were long, right? And waiting for something to give. And they knew that something is going to happen, and at that time, they'll just pull the trigger and exit. And that's what's happened. Is they're so jittery that as soon as there's some signal, maybe there's a correction coming, people just bail out.
So this is the famous so-called fear of missing out. And we saw that in the tech stocks. You felt that even though they'd gone way too far and maybe were overvalued, you just couldn't avoid them. Otherwise, your portfolio underperformed.
Yes, exactly. I mean, the reality was, though, that cautious investors were getting penalised, and therefore the only strategy was momentum. I think the other thing we have to also bear in mind is the fact that a lot of this money was in ETFs and a lot of it was on algo programs. And these are automatic programs that are designed to buy or sell when they hit certain levels. And when you see massive sell-offs, those programs automatically kick in. And that just adds to the problem.
And that's why they use the term flash crash, right? Because you have people who have stop losses at different levels. And the first stop loss gets hit, it goes lower. Next stop loss gets hit, it goes lower. So you have this sudden, rapid fall. And then you've got some other algorithms waiting for the dip. And when it reaches certain levels, they come in and buy. So you have this extreme volatility within minutes. And so that's why I think you're seeing, you saw the VIX go up to 65.
And those investors have had diversified portfolios, which is a good thing, isn't it? You're supposed to have a diversified portfolio because it helps you manage your risk. But if you have done, you haven't done very well because you've been in the wrong stocks.
That's correct. I mean, somebody gave me a statistic recently saying that out of the S&P 500, if you take out the Magnificent Seven, if you look at the earnings growth for the remaining 493 stocks, the average earning growth has been basically less than 1%.
Well, one of the things that triggered this was last Friday's jobs report, wasn't it? Which, let's face it, wasn't bad, but it was just below what investors had been expecting. Then we saw this big plunge in US equities. Now, today, we've had the jobless claims, which were better than expected. So can we now say that maybe the fears over a recession have been overdone and maybe we might get back to normal following these jobless claims, or are we just going to wait for the next piece of data and off we go again?
Well, I think the Fed has said, it looks at all the data. So, people ought to be looking at all the data. And the Fed has also made the point that it's not going to react to one piece of data. Unfortunately, markets don't necessarily see it that way, and certain pieces of data for certain funds will trigger different alerts for them. So the market is probably, as we were saying, it's going to remain volatile because people will take different opinions on the data that they see. I think the comforting fact is that the Fed is looking at the trend line rather than the data points specifically.
That's right. There's a little bit of a confirmation bias, right? I think a lot of people in the market are waiting for the Fed cut and are looking for data which supports that. And so you have a situation where any piece of data that looks a little bit bearish in terms of economic activity, people rush into that and expecting the Fed to immediately cut. So there is a lot of skittishness. I think it's actually irrational in terms of the kind of reaction you find to one data point. Sometimes even just a weekly data point that comes in creates changes in sentiment, which is strange.
So do we need now those rate cuts to keep the markets afloat?
I mean, I don't think we do. I mean, the reality is that the market has been calling for rate cuts just because there are so few people in the market still that remember when rates were much higher than we're seeing them today. And a lot of the junior fund managers, they just haven't had to deal with this before. It's something they've only read about in textbooks. The reality is that high interest rates don't necessarily make companies unprofitable. The key thing is that well-run companies deal with high interest rates and they factor that in. The trouble is, for so long we've had zero interest rates that even the what we were terming the zombie companies could continue to operate. The reality is now, though, that analysts have to look at the difference between the zombie companies and those that are well run and able to cope with higher interest rates.
Sunil, surely the fears over a US recession, do you think they've been overdone? Because we know the US economy is slowing, but that in many ways is what Fed rate hikes were supposed to do, weren't they? They were supposed to slow the economy. But do you think these fears that the Fed is basically too late in starting cutting rates and has sent the economy into a recession, are they overdone, or is there some justification behind those fears?
I think the fears have been around for so long. I remember the recession word being talked about even 2 years ago, right? When the Fed had first taken the rates up to 5% and said, we're going to have a big recession. Last year was all about recession. We're going to have a recession very, very soon because the rates are so high. So I think, people are out there trying to instigate a rate cut really because they know that'll help juice the equity markets. But the fact is that data doesn't support a sudden decline in activity. Every data point you do see slowing down of the economy. You do see job growth slowing down. But that's exactly what the Fed wanted, right? Mm-hmm. So it's moving towards a target. So from a situation where you're moving towards a targeted inflation rate or a unemployment rate to a situation that we've plunged into a recession, I think there's two different scenarios altogether.
But surely there's some economists calling for an emergency rate cut even before the next meeting. Surely that's ridiculous, isn't it? That isn't going to happen.
Yeah, and they forget it's not the Fed's job to bail out the equity market. I mean, I don't know why people make that correlation.
Well, I think a lot of the time people look at the success of the equity market as being the success of economic policy. And that's not always the case. I mean, these people calling for rate cuts, emergency rate cuts, are really probably because their own books are in problems because they've been misinvested.
Correct. And that's the key issue is that, stock prices are not the only indication of economic activity or unemployment. And but of course, if you're in the stock market, all you care about is that.
Do you think then, even if we're not going to get an emergency rate cut, do you think it's likely now the Fed will have to move by 50 basis points when it next meets in September?
I think we've got a lot of data that comes between now and then. I think it's too early to say. I think we have to wait and see what the data indicates.
Yeah, Yeah, I agree, but I think my view is that the Fed already has signaled a decline. I think the stock at 50 is new, right? Just a month ago we were talking about 25 basis points probably, and now I saw futures factoring in 87% probability of 50 basis points, which may be a bit too much. But I think the Fed is clearly has been signaling a decline. Even last week, there will be a decline, but whether it's 25 or 50 would depend on the data. And of course, if there's some other data which is very bullish in terms of the economic activity, even the 25 could be pulled out, like Andrew said.
Let me ask you about Japan. Sunil, you just said it's not the Fed's job to bail out the markets. The Bank of Japan seems to have decided the opposite, that it's its job to bail out the markets, because it seems to have suddenly abandoned its monetary policy because the market's gone down, and it says they're not going to cut rates while the market is unstable. What do you make of that?
I think Japan is a bit strange one because a large proportion of equity holdings are actually held by the government. So there is a sort of a conflict of interest there. So I think that's why this kind of situation is not unexpected.
But it's odd, isn't it? Because just a couple of weeks ago, they raised rates. Governor Ueda said we're going to raise rates further because we need to normalise monetary policy and at least get to a neutral rate, which BOJ board members were saying was around 1%. And then suddenly, a couple of days ago, that's all been ditched. And the deputy governor is saying, no, we won't raise rates anymore, basically.
Well, no, he's only saying he won't raise rates during volatility, which is perfectly reasonable. I mean, the Bank of Japan is there to look after the Japanese economy. It wants to see a stable, open economy. Adding fuel to the fire at this stage obviously would be a bad idea. They're just trying to calm the market. They're not saying we're not going to raise rates. I mean, if the data shows that inflation is coming through and that they can raise rates, they have committed to doing that. And we saw that last week when they raised rates.
But when will they raise rates then? Because if they're waiting for the market to be stable, I'm not sure the market is ever stable, is it? What's their
No, they're not waiting for the market to be stable. They are saying that they're not going to add to the volatility. What they are saying is they will look at the data again. We have to get away between the difference between the real data and not just data points, but the trend of data and the volatility in the market. I mean, they play off each other, but the bank's decision will come from what it sees as the economic data and the trend that's happening there. If the trend shows that it can afford to raise rates, I'm sure it will.
And especially in the case of Japan, I think they're so thoughtful that they will need a lot of data points to make a decision. I think the important signal that was made earlier a couple of weeks ago is more that, look at the direction of rate changes is upwards. Right? Now, it may take years for that to get reflected. But it's an important signal because in the past the signal was we're moving lower and we'll keep it low, right? So I think that signal change that happened 2 or 3 weeks ago was a very important signal. But of course the markets overreact as always, thinking, okay, give me the rate increases now, and that's not going to happen. So I think, like Andrew said, there's a lot of data points besides just the equity market movements.
I think that the thing is, though, that too many people in the market want instant gratification. They want to react to any specific piece of data that doesn't fit in with their program. Whereas, luckily, there are a few grown-ups still in the room that take the longer-term view and they look at all the data, not just one data point in its isolation.
How much is the yen carry trade had an impact on the markets? We know that these positions in the yen carry are just enormous. Has a lot of that been unwound now, or are there still a lot of positions out there that could start to unwind if the yen rallies again?
Well, I think it's the trade's been on for 20 years. I mean, if you put it on 20 years ago when the yen was at 93, you'd want to lock in as much as you can. You might well then re-look at it. But I mean, it was interesting earlier this week and late last week. Again, the Swiss franc suddenly saw huge interest because that's the other, carry trade that's considered a safe trade.
Right. I mean, just to give context, I mean, I think even in the last 4 years, the yen has gone from 105 all the way to 160. So that's almost a 50% increase in the rate. And if you were borrowing yen, so in dollar terms, you would be looking at a liability which is reduced by almost 40% or so 35% or so. So if you did a yen carry trade 4 years ago, your liability went down by 35% and the stock market had gone up by 35%. So they had a lot of profit already locked in. So as soon as the situation happened where they thought the markets may be moving in opposite direction, you had a situation where people took profits, which is logical because they had lots of profits there already.
The problem is we really don't know, do we, the overall size of positions in this carry trade, other than it's probably the largest carry trade we've ever seen in the world, but we just don't know how big. Is that part of the problem?
Yeah, I mean, as Andrew said, the interesting thing is it's a widely known trade. Some of the biggest participants in this trade, believe it or not, are retail Japanese customers, and they've been doing this since the turn of century, more than 20 years, because this differential has been around. So it's not unusual, and it has obviously built up over time.
So where else could this impact? What sort of things do people invest in when they borrow in yen and then convert that to higher yielding currencies? Because presumably that's why we're seeing moves in all sorts of other asset classes at the moment, because they're linked to this carry trade. Is that correct?
Yeah, I mean, the reality is that you short something in Japan, you take the yen and you go somewhere else. But quite often, some of those investments, because this trade has been around for so long, they aren't instantly unwindable. It may take people weeks or months. So the easiest thing to do is to sell equities again to get that yen cash back in and convert the currency. So it will take time for us to see the full unwinding of it. The initial unwinding, though, comes because equities can be used as an ATM.
Sunil, where should we be looking?
I think likewise. I think the people. There was some unwinding when the yen hit 150, and then when it broke 150, people said, "Oh, we're back again." So the people put on new trades between 150 and 160, and I think the people who took profits were really the ones between 150 who got in between 150 and 160. So I think, like Andrew said, it's not unexpected, But since the time that we hit recent lows of 143 or so, the yen has gone back up to 147.5 or something. So it obviously means that there are still people who are willing to take that risk.
Now, while we're talking about central banks, here's something. Donald Trump said yesterday that US presidents should have a say over decisions made by the Federal Reserve. During a press conference on Thursday, Mr. Trump said the Fed had gotten it wrong a lot, and he criticised Chairman Jerome Powell in particular for poorly timed interest rate decisions. He said, "I feel the president should have at least a say in there." And he added, "I think that in my case, I made a lot of money, I was very successful, and I think I have a better instinct than in many cases people that would be on the Federal Reserve or the chairman of the Federal Reserve himself." So what do you make of that?
It's very worrying. I mean, he's also a convicted felon, so do you really want a convicted felon in charge of the books? I don't think so. I mean, the Fed is respected for its independence from politics, and I hope that it remains that way.
Yeah, I mean, I think there is a certain group within the Republican Party who has that view that was reflected by Trump, and it is worrying. And I doubt whether there'll be a wider consensus that will allow for that to happen, because there need to be various changes in the Act of Congress. And so I think it's partly just political talk because of the election, but the worrying thing is that if they have a supermajority, the Republicans have a supermajority, then you could see something like that coming about.
Is this something that markets need to start thinking about and worrying about?
I think it's something that actually Trump's team is probably more worried about him going off script and coming out with these wild remarks and how it's going to affect his election chances than the market is currently. But it will be at the back of people's minds, and hence it will have an impact.
Yeah, and I should also say that this is also there's a part of the Democrat Party who has similar sort of views, saying the Fed needs to be reined in, and the Congress needs to have more control over the Fed. Elizabeth Warren has made such similar statements. So it is worrying when the politicians want to start interfering into the independence of the central bank.
And how important is it to the economy? I presume that if Trump got his way and could interfere, he'd want interest rates lower than what they are and maybe what they ought to be, which presumably is inflationary. So that's where the cost of not having an independent Fed would come in.
Yeah, I mean, I'll give you a classic example of where this has happened and you've seen the impact. That's Turkey, where you had a situation where the president basically dictated what the interest rates were. So even though inflation was 75%, the Turkish central bank kept the rates at 18%. And the economy just tanked, and the currency tanked. So you don't want to see those kind of situations happening.
If you look at China, though, we have the PBOC. Clearly, that's not independence, is it, of the government and the Communist Party? They absolutely control interest rates there. But nevertheless, there seems to be stability. So presumably, it can work as well the other way, can't it?
Well, I wouldn't say that anybody is jumping to get into China at the moment as a reflection that their economic policy is working, because effectively it's not. We're seeing an economy with misallocation of resources. So, they are in a very different position to the rest of the world, and it's because they're putting politics before economics.
Yeah, and also related to that is the level of control that the government has over the markets. Right, and they can dictate when short selling stops. They can dictate who should buy, who should not buy, who should sell, who should not sell. So I don't think you want to use that as an example.
No, we don't even know the real data coming out of China because they keep restricting it. So we have no idea whether it's really working.
And on the data front, we do have inflation data coming out on the mainland later on this morning. That's going to be particularly important. What should we be looking out for there?
I don't think we're going to see any change. I mean, the deflation trend, I think, is going to continue. We've certainly not seen anything from the macro news coming out of China that suggests that it's going to change anything either. We're still hearing about oversupply in EVs, in solar. We're hearing about lack of domestic consumption, and we're seeing from the export data that we saw the other day, we're seeing the fact that their main driver, this export-driven economy, is facing headwinds from overseas.
Yeah, and also the sentiment. I mean, if you look at small businesses or even mid-sized businesses, risk appetite has just disappeared. And there's no confidence in terms of consumer demand, and also just a negative sentiment all over in terms of risk and return.
And what about the currency? Now that the yen has appreciated, does that take some of the downside pressure off of the yuan? And as a result, does PBOC policy have to change? Because it's really been focused, hasn't it, on trying to stop a weakening yuan. If it now goes the other way, what does the PBOC do then?
I'm not sure that the PBOC really has... It's been downgraded by the government. It's a lot of its responsibilities have been moved to other departments or new departments, and hence I don't think the PBOC is really in the driving seat for that much more.
Correct, and also I think small movements in currency are not going to make a difference. The real sentiment is changes because the people feel that they have a lack. The people themselves have a lack of control over their destiny, so they look up to the government to say, okay, what next, and that's a difficult situation. Businessmen cannot allocate capital where they think it should go because they're not sure what government policy is going to bring in the future.
Well, very interesting analysis. Thank you very much indeed for joining me this morning. You heard there Sunil Kashyap, who is director of Finmet, and Andrew Sullivan, who is the founder of Asian Market Sense. I'm I'm joined now by Lawrence Yu, who is Executive Director at Civic Exchange. Good morning, Lawrence.
Good morning, Peter. How are you?
I'm very well, thank you. Now, we're coming up to the time of the Chief Executive's policy address. I know each year you make some policy recommendations for the Chief Executive to consider relating to climate change and environmental issues. What do you see this year as the priorities?
So I think that there are two priorities. One is how do we really race with the climate change, because the temperature gets hotter and hotter. Yesterday we have 36 degrees. This is what also a break record hottest day for Hong Kong. And the second thing is how to navigate Hong Kong under the economy's turbulence, because you can see Monday the stock market meltdown, so that it will be a very challenging policy adjust for John Lee.
Do you think, as a general sort of principle, do you think the world is on track to meet the goals of a zero carbon economy by, 2060?
Actually, I think that even though we on track, but obviously we not, we still need to raise with the adverse climate impact. But now seems first we fail to really meet the target, because now the NOAA already announced that the global average temperature already beyond 1.5 degrees Celsius. And then secondly is the speed is not fast enough to catch up the change of our climate.
So what then specifically can Hong Kong do to try and make sure that we're on track here? What are the specific issues that we need to be taking and thinking about right now in this policy address?
So I think there are a couple areas. The first one, Hong Kong is a finance city. Everything we talk is about money. Obviously, the green finance is super important. And then secondly is how to promote growth of low carbon job and business. And then thirdly is how to really develop an ambitious pathway to transition Hong Kong as a regional green transport hub.
Okay, well, let's look at those three issues then. First of all, in terms of green finance, now, this must be an area where Hong Kong is already successful, isn't it? We already have a lead in this area, so it's just a question of building on that, isn't it?
Definitely, we already take it, and then we have a lot of case that we can champion to the rest of the world. But the question now is how to turn it to be a real economic opportunity, and then also how to take it continuously. So that there are a couple of areas that we need to really think about, like the ISSB disclosure, and then also the taxonomy. And the third is how can we enforce the assurance?
Okay, so in terms of being compliant, the Hong Kong Exchange has rules now for for listing rules for sustainability. They have to be included now in the prospectuses. Is this an area where we can try and focus on attracting new listings, because we're looking for IPOs? They've dropped substantially over the past year. We want companies to come here. Can we promote ourselves as this being a positive thing? Having sustainability listing rules is good, and Hong Kong can be a hub and an example of excellence for that.
Definitely is an opportunity, and there also is a very clear differentiation. How do we differentiate ourselves with others exchange in the world? However, the Hong Kong Stock Exchange still need to work with the government to think about how to provide more support to the listed company, for example, to set up the sector-specific guidance or develop more training for example, what is required to fully compile with the Hong Kong Exchange new sustainability listing rule, and then eventually help them to understand what is the future development from the investor perspective or from the global regulatory perspective.
How do we promote this in a positive way? Because there are companies around the world that see sustainability listing rules as a hurdle, not as a benefit. They see it as a hurdle to overcome and maybe a reason for ignoring or trying to avoid exchanges that have those types of rules. How does that get turned into a positive so that, no, it's not a hurdle, this is a good thing, and you want to come to exchanges that have sustainability listing rules, good quality rules like Hong Kong?
So actually, Hong Kong is playing a very important role to connect East and West. So that, for example, the CBAM or new import rule to European countries already creates a lot of hurdle for the company all over the world. If Hong Kong can be a service provider, help them to really tidy it up and then use the rule in Hong Kong, and then can really mention it is interpermeable to the West standard, so that it can really attract that. And then also Hong Kong can sell our strength, which is the service and assurance, to help them to really align with the European standards. That will make it become more attractive for Hong Kong. And then final but not the least, which is Hong Kong, if the company more disclosed and more transparent, it can help them to identify the problem and then to help them to make the resources used more efficiently, especially now everyone are facing the headwind. It is very important to make themselves become efficient, to build their own resilience, to navigate through the headwind.
Okay. Now, you mentioned we want to promote Hong Kong as a centre for low-carbon jobs and businesses. What types of jobs and businesses are you thinking of?
There are a lot of jobs you can imagine. First of all, I mentioned the assurance at the very beginning as a green finance opportunity. We need a lot of talent, skilled worker to help different listed company to make sure that they are compiled with the listed company rule. So that assurance is one of the key areas. And then secondly, in the future, I can anticipate there will be a lot of requirement for bank or other industry to undergo the climate scenario stress test. So that this is also require a lot of talent to help us to really undergo this kind of stress testing. And then finally, but not the least, you can aware it's now most of the company has listed company has their sustainable expert in-house. But in the future, what I can see is more and more SME also need to join to the task force, so that it will also create a talent needed from the SME, so that this will also create a lot of new jobs that require our young talent, and then we train their skill and then join the sustainability field.
Now, I can imagine that, that some of those jobs that you mention are sort of regulatory type jobs. They're helping companies comply with listing rules and procedures, helping them understand new rules. What about jobs that directly impact the economy, that help grow the economy? What sort of jobs could we be looking at there?
Okay, so that... if you remember, the government is also pushing hard for electrified vehicle or the hydrogen fuel cell vehicle. And then in particular, this particular area, we need to think how to reskill the existing worker from some low value added job to a more high value added. For example, maintenance an EV is require more skill, so that this is also provide the low skill worker to become a high skill worker and then earn more pay. And then also, so far we also get some problem on the municipal soil waste charging. But actually, if we can train more worker that can really work and then have more knowledge, that can really help Hong Kong to change into a circular economic future. So that we need a more high-skilled worker to really know how to sort and manage the waste and then turn it from waste to valuable resources. This also requires a lot of training, but it will also enable a lot of high-skilled jobs that are needed in the future, will make Hong Kong to be a more job opportunity.
So this is all linked to sort of Hong Kong becoming a green transport hub in the region. What does a green transport hub look like? What are the features that Hong Kong would need to have to be a green transport hub?
Actually, we already very green. 90% of our population use mass transit and bus commute to their work from their home every day. But how we can get further to make position ourselves as a green transport hubs, that means that we need more collaboration with the Greater Bay Area to really see different city strengths and then work together to accelerate like how the logistics sector or the goods vehicle. This is super important for Hong Kong if we want to maintain ourselves as a green transport hubs. And then also think about how can we attract the seagoing vessel back to the Hong Kong port, and then also provide them some support to help them to gradually transit into like the green bunkering field. This is also quite important. And then thirdly is in European, they already talk about the green aviation field, so that we also can really think about how can we work with other aviation airports nearby the GBA, and then to use the advantages that our local flagship carrier established, which is this commitment of 10% of the sustainable aviation fuel by 2030 to lead the regional aviation industry transition, so that these three areas will be very quite important action that the Hong Kong Chief Executive need to think. But one more thing I want to mention, we also can reduce our carbon emission rapidly through adopt the biodiesel, because very near term, Hong Kong vehicle user can also refuel their vehicle with the biodiesel, so that the government also can think about how to make it can be a lower hanging fruit solution to reduce the transport sector carbon emission immediately.
I would have thought we've got a long way to go, haven't we, to be really a green transport hub. I mean, there's still a lot of people who drive to work and drive around Hong Kong in their cars. You only have to see the congestion in the mornings to see that. We have taxis that are, internal combustion engine vehicles. There are nowhere near enough electric chargers around. We've got a lot of things to do, haven't we, to become a regional green transport hub?
Yes, we have a lot of do, but we also need to recognize our strength. For example, the chargers. Actually, we already catch up the well. For every 10 online electrical vehicle, we have one chargers. And then actually the EV owner not really necessarily charge every day in Hong Kong. We need to champion ourselves. We are fast follower. And then for the taxi, we need to take this opportunity to really think about how can we combine use the fast charging technology, and then also reference the mainland technology, bring it to Hong Kong, and then showcase to the world Hong Kong can really rapidly transit our taxi to make it more efficiency, and then less really influenced by like the global oil price. And then finally, Hong Kong needs some champion to take lead to change people behavior. Maybe I really hopeful our senior government official can really champion, like Boris Johnson very long time ago, how he encouraged Londoner to use public transport, which is he commute to work with by public transport or bike. So that this is really good way to show the whole community that the government want to champion this, and then also not really necessary with a lot of cost. It's very low cost solution, but can drive significant impact.
So maybe then we need to see John Lee cycling to work in the morning as the champion. Lawrence, thank you very much indeed.
Thank you so much, Peter.
That's Lawrence Yu, who is Executive Director at Civic Exchange.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thanks to my guests this morning, and thank you for listening today and this week. If you want to get more details on some of the stories we've discussed this morning, please go to my website, peterlewismoneytalk.substack.com, and have a read of my daily newsletter. I'll be back on Monday when I'll be joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Tim Huxley, Chairman of Mandarin Shipping. And providing a view from mainland China will be Shanghai-based independent economist Andy Sher. Have a great weekend.
Money Talk.